So hi, everyone. My name is Jaclyn Cecereu. I'm a financial planner here at PWL.
And I'm Nicholas. I'm a financial planning associate also at PWL.
Nicholas and I field a lot of questions about whether financial decisions are right or wrong, good or bad. What we do know is that earning more money is actually truly an addictive thing. It activates the same regions of the brain as doing illicit drugs. So not to start us off on such a strong note, but that is a fact. The problem is, from your brain's perspective, more money is always a better thing. More money is always better than what you have today, even if you already have a lot of money. So knowing that more money is addictive, an important question for all investors to ask themselves is, how much is enough? And I'll tell you the answer right now. Enough is the amount needed to fund a good life. And this will be subjective, of course, but what we do know is that framing financial decisions through the lens of life satisfaction rather than just dollars is much more likely to lead to better outcomes. So with that said, what Nicholas and I want to spend a little bit of time on today is thinking about how the pursuit of a good life relates to your investment decisions. We'll then talk a little bit about how to put this all into practice, so how to invest once we've determined what a good life looks like, and we'll leave lots of time for questions at the end. This session will really work best if you participate. I don't particularly love hearing the sound of my own voice alone for an extended period of time, and I know what it's like to listen to someone else talk at you on a Zoom call for a while. So it's in all of our best interest if this is more of a discussion than a seminar. Feel free to interact with the presentation. If you've never used Mentimeter before, you can scan the QR code on the screen, or you can go to menti.com on your desktop. That will allow you to comment, ask questions right through the presentation, and feel free to stop us at any time if you have a question or a comment. We see them as we go, and we'll try to address everything as we go along. And like I said, if we don't get to your question through the presentation, we have lots of time at the end for questions. So I'll give you a minute to get that going.
And then when you're ready, we'll be off to the first Menti question. So was money talked about openly with your family and friends growing up?
Right
No.
away, no.
A little bit. No. Oh,
So interesting. Not at all. Okay. Lots of no's.
more than I thought.
Wow. Okay.
Interesting.
Very interesting. What we do want to say today is that this webinar is really a safe space to talk openly about money. Often people grow up not talking about money, not thinking about money overtly. So we want this to be that place. Feel free to go anonymous or use an alias in the chat if that makes you more comfortable, but please don't hold back. Not until university. That's interesting. Okay, so to kick us off on our finding and funding topic, please feel free to answer this following question. Are people good at predicting what makes them happy?
Looks like it's unanimous.
Yeah, not one person thinks we are.
Oh.
I just want to point out that I see a James Bond attending, and I really wonder if that's your real name.
And Dwayne Johnson just commented as well. Thanks for coming.
Dwayne Johnson. Awesome. Give you another minute or so. Got a bit of a balance here, obviously tilted towards the no. Okay. So I will give you the answer. The fact is that no, we are really bad at figuring out ahead of time whether our decisions will actually make our future selves happier. We have a tendency to believe that who we are today is pretty much who we'll be tomorrow, despite the fact that it really wasn't who we were yesterday. So I'm in my 30s now. The gray hair speaks for itself. I will not divulge any further details, but I will argue that I have changed a lot since my early 20s. However, if you had asked me in my early 20s how my life, my personality, my preferences might change over the next decade or so, I would never have guessed that I would be this version of me. I probably would think that I'd be some version of the same early 20-year-old that I used to be. So with that in mind, there was a study done many moons ago in 1978, actually, where researchers looked at the effect of major life events on our long-term happiness. So in this case, it was winning the lottery versus becoming disabled. And what they found was that in the short term, yes, happiness was absolutely influenced by whether you became very, very rich or suffered a disability. And intuitively, that makes a lot of sense, right? But after about a year and a half, what these researchers found was that those individuals in both groups more or less reverted to their original state of happiness. So this is affective forecasting at work. If you've ever heard of the term hedonic treadmill, this is it. We get used to stuff. And I'm sure you all have very salient examples of this in your own lives. One that's top of mind for me is the drive to go and visit my parents. I used to live about an hour and a half away from my parents, and that drive just felt really, really long because I was doing it often. This was COVID times and they were my bubble. I've since moved and my parents are now a 20-minute drive away at most. And what a shift. That was an awesome change. Going to visit them felt like such a breeze. But then I got used to it. It's my new normal. And now that drive feels, again, really long to me. Anyway, the world's tiniest violin is playing for me right now. But the fact is that people are sensitive to changes in their circumstances, but they adapt pretty quickly to those changes.
So taking it a step further, here's the next question on Mentimeter. So what contributes the most to our happiness? What do you think is the order of the three options above? Very good. I think it's stable. So it looks like some are out of order, but we'll talk on that.
Still a few coming in.
Okay, so in fact, we find that a chunk of our happiness comes from our heritable set point. So meaning that our happiness is baked into our genetics, our gender, sex, race, who we are. So some people are predetermined to be happier than others. Unfortunately, there's not much we can do to change that. The good news, though, is that a larger part of our happiness comes from the voluntary activities we choose to engage in every day. Whether that be going to bed early, exercising, traveling, we have the power to control our happiness. We find that in last place, our circumstances, such as where we live and how much money we have a smaller impact on our overall happiness. Because as Jaclyn explained, we're really good at adapting. However, that doesn't mean that circumstances don't matter. In fact, we highlight circumstances that do matter. So noise, especially variable and intermittent noise, can impact our concentration and increase stress. So you may have noticed that when trying to sleep, it's easier to tune out the regular hum of an air conditioner than the sound of a busy intersection. Commuting is another. Studies show that even regular commuters arrive at work with higher levels of stress hormones. Maybe it's not worth living in the suburbs if you have a stressful 30-minute plus drive twice a day. Feeling a lack of control over your circumstances is also bad for happiness. Studies show that even just controlling the plants in your home can help a lot. Being nature is important. People who have access to nature and green space tend to be happier and have higher life satisfaction. And it's also associated with an increased sense of meaning and purpose in life. So on to the next topic. Grab your phones again to answer the following question. When buying a gift for someone, do you prefer to shop for things or experiences? Oh, things is catching up, but still looks like experiences. Oh, we're pretty 50-50 almost. Well, I'll give you the answer. So studies show that spending on experiences is more impactful than spending on things. So reflecting on past experiences enhances mood more than reflecting on past purchases. For example, you likely have more fond memories of the weekends hiking with friends than your fancy hiking shoes you bought. These experiences are easier to remember and make up who we are. Going back to the idea of adaptation, it's harder to adapt to experiences than things because each experience is unique while things are static. So no two bike rides or dinners out with friends will be identical. But the same can't be said for your new car that will eventually lose its new car smell. Spending on others is also more rewarding. Studies show that personal spending is generally unrelated to happiness, but pro-social spending, such as charity and spending on others, is predictive of happiness. As social beings, interacting with others is an important source of happiness. It's less adaptable, and sharing experiences with others can build stronger relationships, which increases happiness. It's also important to note that although things and experiences can vary wildly in costs, the best experiences don't have to cost anything. Hiking with a friend, spending time with family, those are free or can be free and no less impactful than paid experiences.
So we've talked about spending. Now let's talk about the other side of the coin, the income that it takes to be able to spend any which way. We'd like to hear from you. At what level of individual income does happiness stop increasing? This level, this point is also known as the point of income satiation. Quick little disclaimer. This is not a trick question, but the amounts that you're seeing are in US dollars. So keep that in mind. Okay, I love the variability in the answers to this question. Everyone's got a different idea of how much income it takes to be happy. Most people are going to the lower end of the spectrum, so that's pretty cool. There are a handful, though, that think we have to make roughly $500,000 to be happy. Our happiest, I should say. So we trade our time for money at work, but working harder for more money is not always the obvious trade-off. Happiness does not rise indefinitely with income. So there is a point at which higher income no longer leads to greater well-being. It was found in a global sample of over 1.7 million people, this was in 2021, that the point of income satiation for long-term reflective happiness, that's the kind of happiness where we feel deeply fulfilled, was actually $105,000 US per year. So for anyone who did answer $105,000 US per year, you get a prize of being correct and just the pride and the nice feeling that comes with that. In certain parts of the world, including Canada, incomes beyond satiation are actually associated with lower life satisfaction and decreased happiness. We can, of course, speculate on why this might be. The most obvious is that higher incomes often mean higher demands on our time, which also limits opportunities for positive experiences outside of work. So spending time with our kids, our spouse, our friends, working on our hobbies, or working out in the community, and so on. So money is not the be-all end-all. That much we know. Let's talk about now how to set relevant goals beyond just making more money. We've already talked about how we're not very good at figuring out ahead of time if our decisions will make us happy. And unfortunately, we also know that we're not very good at setting goals either. So the real problem is we don't know how to identify what's important to us, and identifying objectives or goals to work towards that are based on our values is important. It's very important to making financial decisions. So to understand money's role in well-being, we can think about what actually influences our well-being as humans. Martin Seligman, who co-initiated the entire field of what we know as positive psychology, introduced to us the PERMA model of well-being. So you can see PERMA on the left side of the screen. P for positive emotions, just feeling good, feeling happy, feeling content on a day-to-day basis. Engagement being having a sense of flow. This typically requires some balance between engagement and challenge on what you're working on and what you're doing. Also, strong, healthy relationships are a very strong indicator of our overall happiness and well-being. Meaning, so having a sense of purpose beyond yourself in your community, at work, in your family, whatever it may be. And finally, accomplishment. So again, this can be at work, in sport, or in hobby. Noticeably absent from the PERMA model is anything related to physical health, but there is strong intuitive evidence that vitality, so diet, exercise, and sleep, leads to improved physical and mental well-being. So this was later added to the PERMA model down below vitality. Now, a good life for one person may be different from a good life for another. Nicholas's definition of a good life is very likely different from my definition, but understanding the factors in this model, the PERMA-V model, can help us consider the most important non-financial elements involved in making financial decisions on a day-to-day basis. So with that in mind, how do you go about setting goals? Oh, this is a Mentimeter question if anyone wants to participate. There we go. Oh, I forgot this kind of question takes a while. I wonder how many individuals are choosing more than one option.
Yeah. No help though, no seek assistance. Or very few.
Very few. A lot of individualists on the call. Okay, super. So there is a right answer to this. Thanks for entering your preferences. It's kind of a trick question. The ideal way to go about setting goals for yourself is actually a total combination of all four methods. So working independently to come up with some goals, having deep reflection about those goals, then checking to see what other people's goals are, and also seeking assistance to come up with your goals. So our team has actually put together a financial goals survey, and the link is dropped right there in the chat if you're interested to check it out. This survey follows the following process. So first, what you want to do is generate a list of goals without any outside help. So let's say you write down 3 goals that you want to accomplish. And remember that financial goals are the end state, not the means to get there. So as an example, if you want to save to buy a house, you want to save $50,000 to buy a house, that's the means to get there. The end state is I want to feel secure in where I'm living. So if you write down your first 3 goals, knowing that this initial list will be deficient because humans are bad at setting goals, the next step is to try and then double the number of goals you've identified. So you wrote down 3, now make it 6. Then after doubling your list, you will compare your 6 goals with the PERMA-V model. So now you're going to compare to the model and look for some insight. Reflecting on these non-financial categories should elicit more goals for you, or even help you sort through, reprioritize the 6 that you already have. Finally, if there is a master list of goals available, you should consult it. And the vast majority of people will change their top goals based on seeing this master list, something like what you're seeing on the right side of the screen here. So if you do the PWL goals survey, you will find a master list in there to use. So we hope that is helpful.
Okay, so we just finished talking about finding a good life. So now let's move on to funding a good life. Now, an important concept is the difference between human capital and financial capital. So when you're young, you generally have very little financial capital. So that's money in the bank, retirement savings, and other investments. So you have to rely on your human capital, your ability to work and earn a living, to fund your lifestyle. As you work and get older, you're trading your time, knowledge, and energy to build financial capital so that one day you and your family no longer have to rely on your human capital, which is generally worth much less in your later years. For a more detailed look at human capital and how incomes change over time, check out our colleague Jordan Tarasoff's new article that Jaclyn just put in the chat. So when building a financial plan, consider these 5 must-haves. So protect your human capital. As we said, your ability to work and earn a living is extremely valuable. It's important to have the right amount of life and disability insurance to ensure that you and your family are protected if you pass away prematurely or become disabled and can't work. If any of you listen to the Rational Miner podcast, Cameron, you might have heard Cameron say, if you can't afford disability insurance, you can't afford not to have it. So in other words, if you don't have enough money to afford the premiums of disability insurance, you likely won't be able to afford your current expenses if you can no longer work due to a disability. You also want to save on a regular basis, convert your human capital into financial capital so that you can retire one day. Compounding works best when you start early. Get a will to ensure that your wishes are respected when you pass away, and make the lives of your loved ones easier during that time. Use your registered accounts to enjoy tax advantages that will boost your savings. More on that later. And develop a plan you can stick with. For example, going too aggressive with your investments can scare you off from investing and hurt you in the long run. Once again, more on that later.
So this top 5 list that Nicholas just went through is a small part of what any financial planner would be reviewing for you and giving you advice on. So we thought we'd take a moment to talk about what financial advice is, or more specifically and more importantly, what good financial advice is. Now, before we talk about what constitutes good financial advice, let's start with what does not. So financial advice based on choosing investments hoped to beat the market is not it. Financial advice that views investing as the problem to solve as opposed to one piece of a broader solution is also not it. So if this type of information is being sold to you as financial advice, we strongly encourage you to run quickly in the other direction. On the other hand, you have professional, good, reliable financial advice that can be relied upon to help you make high quality financial decisions. This kind of reliable financial advice can be categorized in 5 areas of expertise. First is goal formation and quantification. So we talked a lot about goal formation. Optimizing based on a set of known goals is just a math problem, but setting the goals is much more challenging, and that's what a good advisor can help you work on and come up with. Next is asset allocation. So given a set of goals, how should you allocate your financial assets? This is one of the most important determinants of investment outcomes. Your financial assets, including your investment savings, as well as your debt and your human capital. So at this point, things are shaping up, right? There are meaningful goals in place. Those goals have been quantified, and now an asset allocation has been determined to meet those goals, but there's still a gap. And this is what Nicholas was referring to earlier. That's where life and disability insurance enter the conversation. So this may be the least fun thing to think about, along with preparing your wills and doing any sort of estate planning, but some of the most important components of a financial plan. I see in the chat, there is a mention for Willful, so like an online will software that is super simple for you to do. The advice that we typically give on that actually is to avoid those if you can. So they're really great for simple situations, but as long as as soon as there are any sort of variations or specifics to your situation, you really want to have it done properly by a professional, by a lawyer. Now, of course, the advice that we've received from the lawyers that we work with is biased because this is what they do for a living. But we have heard from several lawyers that we trust and work with that it often is more expensive to undo the mistakes of an online will later, so after a death, than it is to just do it properly right up front. So that's a side note on the insurance needs and estate planning portion. So now with the insurance needs addressed, we can start thinking about financial products, evaluating which financial products, or in other words, which ETFs or maybe mutual funds to invest in, really cannot be done, or at least cannot be done well, without the context of a broader financial plan. In many cases, as we've already talked about, I am a broken record. Financial advice starts with the product. I would call that bad financial advice. I said what I said. I will leave it at that. Lastly, looming over all these steps are taxes. So tax awareness at every step has the potential to meaningfully improve your outcome, and it is absolutely crucial to consider at every decision point in your financial plan. Now, these are all things that can be accomplished on your own with your own research. I'm not going to sit here and tell you that everyone needs professional financial advice on an ongoing basis, but it does help to reduce complexity, save time, and overcome biases. I think Joseph mentioned something in the chat earlier that we are in needing of advisors because of the biases. We can't make good decisions that are objective based on our own financial situation. That is absolutely true, and one of the huge value adds of working with another advisor, having an objective sounding board to help you manage the trade-offs in your financial life. Regardless, it's important to remember that above all, financial advice is not about fund managers, and it's not about which stocks to pick.
If you do think that expert financial advice is important, you can work with a professional in generally one of two ways. So you can work with a full service advisor, like what we do at PWL Capital. We focus on what Jaclyn explained and offer many services, including portfolio management, research, retirement, estate, tax, insurance planning, coordinating with other professionals like lawyers and accountants, and providing ongoing support. So firms like ours are often paid from a percentage of assets under management. And generally, this option is great for people who need ongoing advice and those who don't have the time or desire to manage their finances on their own. Another option is fee-only or fee-for-service advisors. These advisors are generally paid for their time, either hourly or a fixed price for a comprehensive financial plan. So for example, you can visit one that will sit down and work with you on a retirement plan for a set price, let's say $1,500 for a comprehensive financial plan. And once complete, you'll have a blueprint that you can go implement. So internally at PWL, a good way that we try to explain it is comparing it to a personal chef and a nutritionist. So with a personal chef, you will share your preferred meals or nutritional goals, and the personal chef will go out and make a meal plan. They'll source the ingredients, prepare the meals, and serve them to you. With a nutritionist, you will share your preferences, and the nutritionist will help with a meal plan, but the actual shopping for ingredients and the cooking will be done by you. So one isn't necessarily better than the other. What matters is that you're getting good financial advice, as Jaclyn said, and that you're comfortable with the option that you choose. So if you believe that a fee-only financial planner and mixed with DIY investing is the route for you, you have a few options to manage those investments. So a good option for those starting out are robo-advisors. When setting up an account with a robo-advisor, you'll fill in a risk questionnaire to determine your asset allocation. You make the contributions, and the robo-advisor will take care of purchasing the investments and rebalancing periodically. They're convenient and can cost you anywhere from between 0.4 to 1%. Common options are Nest Wealth, Questrade's Quest Wealth portfolios, and Wealthsimple Invest. If you want to optimize further and decrease costs, you can purchase all-in-one ETFs offered by investment managers such as Vanguard and iShares. So you can do so by setting up a self-directed brokerage account with Questrade, Wealthsimple Trade, or any of the big banks. And these are single funds that invest in stocks and bonds from around the world and are rebalanced internally. So I said ETFs earlier, so that's exchange traded funds. So for this option, you must be comfortable placing trades on a stock exchange, but the fees can be as low as 0.2%, which is $20 per year for every $1,000 invested. And as you see on screen, there are different all-in-one ETFs that correspond to different asset allocations. The asset allocations are a mix between stocks and bonds and will determine the level of volatility. In other words, the ups and downs of the market of your portfolio. So company stocks provide you with higher expected returns, but also more volatility. Bonds can be included in the portfolio to provide a smoother ride and help you allow you to buy more stocks when the market is down. As I said earlier, pick an asset allocation that will help you stick to your plan. Whichever you choose, though, your best bet is to place these investments in registered accounts to enjoy their tax advantages. So in Canada, we have a few registered accounts that have different mechanics, as you can see on your screen there. So the RSP lets you defer paying taxes on income contributed until you use it in retirement. The TFSA lets your investments grow tax-free until you need them, preferably in retirement. And don't let the name fool you. It's more than just a savings account. And the RESP lets you save and invest for your child's education while earning additional grants from the government. Your children will pay tax on any investment income and grants when they withdraw to go to school. And the new FHSA lets you invest money tax-free for the purchase of your first home, while also getting a tax deduction on your contributions. So it's kind of the best of the RSP and the TFSA in one. Now, we're happy to answer any questions about FHSA contributions, RESP grants, RSP deductions, or any other topics we discussed today. I see there's one on the screen right now. And the question is, do you recommend getting disability insurance on top of what we have from the company? So I'm guessing what you're saying is through work, through your group insurance plan. So ultimately, what matters is that you have the right amount of disability insurance. So you have to take a look at what your needs are and what's provided through work. So that may be enough, and it may not be enough. And you'll want to look into that.
Yeah. One thing to consider too with your group policies, if you want it to be super conservative, what could happen tomorrow is you lose your job and you also become really unhealthy, and you aren't able to access disability insurance at that point. So often it makes sense to either top up your group policy with a private policy. So you can buy what's called top-up policies that will kind of bump up your income to where it needs to be, to the maximum that coverage that you qualify for. And that would generally protect you as much as possible while you're working for the company. If you want to take it even a step further, you could just have your full coverage kind of double covered by a private policy. We don't see that a lot because disability insurance is a fairly expensive coverage. And the reason it's expensive is because more people become disabled than we think. So it's very common. So I hope that answers your question. The TLDR is your company policies, your group policies are great start, and it's better than nothing, but often there's an opportunity to improve it with a private policy, typically by topping up your group coverage. How do I decide what account to use for my investments? That's you, Nicholas.
Sounds good. So it's hard for me to tell you right now what the best account for you is, given that I don't know a lot of info about you, but I can give kind of a good framework if you'd like. So first, the first home savings account. So that's a new account that helps you to save for your home. So you can contribute up to $8,000 per year, and you get the deduction on your contribution. Now that money will grow tax-free until you use it for a home. But if you tell yourself, oh, I'm not going to buy a home, you can still open the account. You can always keep it for 15 years and then transfer it into your RSP. So if you think that you're a lifelong renter, the first home savings account can also be a retirement account that can boost your RSP. Now, in terms of the TFSA RSP, the best way to look at these they're both retirement accounts. So there is some flexibility with the TFSA, and you can use it for other purposes, but its best use is for long-term tax-free growth. Now, in a world where there's a flat tax throughout your life, the math shows that the TFSA and the RSP is the same. Where it differs, though, is when you contribute to an RSP, you get a tax deduction. And the best thing to do is, or the optimal way to do it is when you're in a higher tax rate than you expect to be in retirement, you want to prioritize the RSP. If it's the opposite, you would want to start with the TFSA. The TFSA is overall more flexible, so you may want to start with that regardless. But ultimately, without knowing you personally, I can't really tell you which account that you personally should start with.
So there's a question in the chat as well. Can the FHSA be used in any way for folks that have already bought homes?
No, so for that one, if you're familiar with the home buyers plan, so that's part of the RSP, it's the same rule. So neither you nor your spouse can have owned a home own a home that you lived in within the last 4 years, if you'd like to use the FHSA.
Yeah, so for any homeowners, you could not use it for your own situation. What we do see, though, is parents or grandparents looking to help the younger generation save efficiently for a home. So if you're planning to gift your kids money anyway to help with the down payment, you're better off gifting it to them so they can contribute to the FHSA, get the tax deduction, and then pull the funds out for their down payment. So it's just optimizing it, make it more tax efficient. Doesn't affect your tax situation, but it helps your kids have a more tax optimal home purchase. There was also a question from Rodrigo. What's the RSP implication of that move? I believe the question was about FHSA to RSP. There's no tax implication on the transfer from one to the other, FHSA to RSP. Intuitively, the way I think about it and makes a lot of sense is you already got the tax deduction on the FHSA contribution, so you're not going to get an additional contribution on the transfer to the RSP. That would not be fair to the taxman.
You also, if your lifelong renter wants to just max out the FHSA, you can contribute it and you wait the 15 years. At the end of the 15-year limit that you can have the account, you can transfer it into the RSP, and it's not going to use your RSP room. So you don't need RSP room to do that transfer.
Something I just found out today that I found interesting from Evan: TFSAs aren't protected from creditors while RSPs are. Yes, that is true. How early can you open an FHSA for your kids? Your kids have to be 18. So at that point, they can open an FHSA in their name and they're good to go. How do you guys determine what factor exposure at PWL? So I posted a link to our head of research, Ben Felix, who many of you may know. He wrote a paper on 5-factor investing with ETFs that discusses factor exposure. Essentially, it's how to mimic our PWL portfolios, but with your own ETFs. So feel free to give that a read. There's also a video if you want to give that a read for more information. PWL has a great white paper on determining the value of life insurance needed. Does PWL have a white paper or blog on determining the recommended value level of disability insurance needed? That is a great question. No, we have not. I don't think, right, Nicholas, that we've written on disability insurance yet.
Nothing comes to mind.
Yeah. That is noted for a future blog post.
To
Incoming.
do.
Yeah. We don't hear much about whole life insurance and when, if ever, it would be a good idea to consider it, look into it. So we actually have a whole life insurance white paper coming out very soon. Stay tuned for that. And it will talk about all the situations where permanent insurance is appropriate. There are often estate planning situations where permanent insurance is absolutely needed and the best solution for clients. More often than not, though, we see permanent insurance sold for the sake of the high commission on the advisor side, or there's a bit of smoke and mirrors with the promised investment returns within the policy itself. So it's unfortunately sold to clients that don't necessarily need it in a lot of situations, but more coming there. That paper is in its final stages, so if any of my colleagues are on the call, they know we are eager to publish. So should I focus on paying off debt before I start saving for retirement? That's a great question. Do you want to take that one, Nicholas?
Sure. Ultimately, it kind of depends on the interest rate, but one way to think about it is let's say the market, there's an expected return with investing. And let's just say the expected return for your portfolio is 5%, let's say. Now there's risk with that 5%. And then there's also, outside of the registered accounts, taxes on that 5%. So real return after taxes, it might just be, let's say 4%, whatever, but there's risk attached to it. Now you may have credit card debt at 20%. You may have line of credit debt at like 7%. Now, when you pay that off, that's an after-tax return, if you will, of 20%, 7%. So especially at higher interest rates, you're better off paying off the debt before saving for retirement. But yeah, anything else you want to add to that, Jaclyn?
Yeah, you mentioned the credit card debt. That's an obvious one. So credit cards are usually carrying like above 20% interest. If you pay down your credit card, you can think of that as like an automatic 20% savings. Whereas if you didn't pay down your credit card, you're going to be paying 20% plus in interest on the debt outstanding. So credit card's a no-brainer. Line of credit is a gray area depending on how it's structured. If we're talking about mortgage versus saving for your retirement, I would take a serious look at your income, what tax bracket you fall in, again, the interest rate that Nicholas mentioned, and it's not a black and white answer for everyone, unfortunately. This is the value of advice, why you should consult an advisor. Okay. If you want to buy a house using the FHSA in 5 years, should we invest in lower risk investments such as GICs?
I'll take that. Yeah, so really that's back to our question of asset allocation. So if you know you want to buy a house in 5 years, you want to make sure that the money's there when you need it. So nobody can tell you where the market's going to be in 5 years. We can tell you that over the long term, the markets tend to go up, but we don't have a crystal ball telling us what the next 5 years looks like. So that would definitely merit a lower risk for like a 5-year time horizon. So GICs could be appropriate. Now, as you approach the 5 years, you don't know how fast you'll buy a home. The liquidity of GICs may be another concern. But overall, this is an asset allocation question. And you want the money to be there when you want to buy the home.
Yeah, and a quick side note that GICs are not paying much more than high interest savings at this time. So the additional risk that there is in GICs is that it's locked up. So if you really want flexibility, like I want to buy a home at some point in the next 5 years, but I don't know when, and then you find the perfect home in year 2, but all your funds are locked up in GICs, that is not ideal. So if there's a possibility that you'd buy sooner than the 5-year term, which I mean is pretty realistic when you're shopping for a house, you probably want to keep it in high interest savings, but there's no real right or wrong answer to that. It's just your preference. Would you say there is a significant difference between dimensional factor funds versus Avantis? Would one be better than the other?
Is Ben Felix on the call?
They are different. Avantis offers ETFs. For Canadians, we use dimensional mutual funds. The ETFs are only available in US dollars. There are slight differences. If you look at Ben's paper, the one that I referenced earlier, I can't remember. I think he actually does include the Avantis ETFs in there. This is your question. Any thoughts on leveraged investing in the current high interest rate environment, assuming all registered accounts are maxed out? Great question. So leverage is obviously a risky investment strategy. A few years ago, when interest rates were a lot lower, it seemed like everyone and their dog was interested in the leverage strategy. Now that interest rates have gone up, people have kind of scared off of this quite a bit, but there are people who are still interested in it. Ultimately, well, often what we see is the goal is to first have a paid off house and then to borrow against a house or another asset to invest in your portfolio. So by doing it in that order, what happens is the interest on the debt becomes tax deductible because you are investing against an asset that you own completely, and you're investing in an asset that is income producing. So on that note, you can't invest in like a single growth stock because there's no expectation of income. So it has to be something like a diversified portfolio that is expected to produce income. So if that's the kind of leverage investing that we're asking about, it can still be suitable. Practically and anecdotally, what we see is that once we have a paid for house, it's really hard to then go and take out a whole new mortgage or a whole new debt against that house, against that property. Just psychologically, there seems to be a limit there. So even though often we plan for this with our clients, like, okay, we're going to pay off a mortgage next month, and then we're going to go ahead with the plan that we've been talking about for the last year to borrow against the house and refinance and then invest in the portfolio. Often, once the house is paid for, it feels really good to have a paid for house. So that's where the buck kind of stops. We do have clients, like I said, that we work with who still proceed with the leverage investment. And as long as you're psychologically okay with making payments on your debt while interest rates are fluctuating and potentially rising, and as long as the expected return on your portfolio is greater than the after-tax return on your debt, it can still be a suitable strategy. It's just something that we need to keep a close eye on, especially in an interest rate environment that we're living through right now. I hope that makes sense. And yes, there's an assumption is that your registered accounts are all maxed out. That is what makes the debt, the interest tax deductible. Would the answer change for a renter versus a homeowner for the leveraged investing? Well, it's tough because then you can't really you have to go and borrow against something to invest in the portfolio, and it's tough to, you have to have that asset to borrow against.
And generally unsecured debt has higher interest rates than secured debt. I want to say Ben Felix had an article in the Globe and Mail about something like this. Even if it's more optimal, I think it goes down to the psychology of it.
Rodrigo shared in the chat, Larry Cecereu states in his book, one should adapt the risk level to our ability, our capacity, and our need to take on more risk. That's a fabulous point. Larry Cecereu is a huge influence on our team and the advice that we give. This is in his book. This advice to adapt your risk tolerance to these 3 characteristics. It is absolutely true. If you don't need to take on the additional risk, or you can't stomach it, or you don't have the income or the assets to do it, it should be a no-brainer. Don't do it. Okay, next question. GIC rates are really good. Does it make more sense to invest in them right now than investing in the stock market? This is a phenomenal question. We get it all the time, especially as rates are going up. It's really hard to look at a guaranteed GIC rate and then maybe see your fixed income or your bond portfolio not really catching up or not keeping pace. And then think the obvious question, why the heck am I in bonds? Why don't I just shift everything over into GICs? There's a couple of things you want to keep top of mind here. So GICs, as Nicholas mentioned earlier, there's liquidity concerns there, not liquid. Okay, so as interest rates change, you can't adjust with whatever's locked in your GIC. Also can't access the cash if you need it. The other thing is your bond portfolio has a higher expected return. So if GICs were for sure going to give you a higher return, everyone would sell their bonds and go into GICs. Then it would make the prices of bonds fall and the expected return of those bonds go up. So then people would sell their GICs and go back into bonds, right? Like this is just the cycle of supply and demand of bond portfolios. So you have to think as a bond investor, as a long-term investor, you'd prefer to be in bonds for the higher expected return, knowing full well that you're not going to get a guaranteed return every year. You're in it for the long run. Anything to add there, Nicholas?
I think that was good. I think I'd add it's also that's market timing, and it's really hard to do. Even people who do this for a living, it's really hard to market time. In general, you'll have a worse outcome. You may see GIC rates and see the recent return on your portfolio and say, hey, I'm going to GICs. But now when do you decide to go back into your portfolio? You're likely to miss out on gains there, but you never know.
How do I find the right balance between saving for the long-term goals, retirement, versus enjoying life today? That's a great question. I wish I had a black and white for sure. Here's your silver bullet answer. It's always going to be a balance between looking out for your future self and enjoying life as your present self. That is really the value in having a financial plan. So off the top, when you have a financial plan, you can see what the trade-offs are. Right? So if I save X dollars amount per year, that means I can only spend this much per year. And if I only spend this much per year, I might have to go on a cheaper vacation. And if that is not necessarily something that you want to do, then you can, again, see the obvious trade-off. You can see the impact. Okay, I want to go on that vacation this year. What's it going to cost me in savings? And more importantly, what's that going to cost me every year compounded in years worked? So that's something that we often show to our clients is, if you buy the bigger house or if you buy the more expensive car, what does that mean in terms of your retirement age? How many years is it pushing it back? And if you're okay with that decision, I say retirement, I mean financial independence is probably a more appropriate term. If you're okay with that trade-off, then by all means, take the extra vacation, buy the bigger house. But it's really important to be able to see the long-term plan and see the impact of your decisions. Dwayne Johnson, great comment. Find ways to enjoy life that don't cost money or ideally make you money. That is brilliant. I think Did we answer? Oh, we've got more questions. Okay. Awesome. So I think we've answered all the questions just in time. If anything else comes to mind, or if anyone on the call is interested in speaking with an advisor on our team, feel free to book a time in my calendar. The link is right there. We can chat through your situation, and I'm happy to do that with anyone here. And finally, we'd love to hear your feedback on the seminar in general. So we do these webinars often, and we love to hear what went well, what didn't go well. So there's a link again right on the presentation to a quick 3-minute form if you want to just share your opinion with us. And I think that's all. Thanks everyone for your time, and thanks for joining us today.